I never have been interested in academics.
Certainly, this maybe a stupid question, but for the quizzes,
Yeah.
what if, is it bad for you if I don't pick up my quiz because I have your solutions? I have the grade on Brightspace.
I'll tell you why I'd like you to pick it up, because otherwise it's going to become recycling very soon.
Oh, so you prefer us to pick it up?
And keep correct, that way later on in Brightspace, if there's a mistake and I go and read, I'm recording override the number and put a different number, and you'll have nothing to prove that I was wrong.
I prefer not, I prefer you don't do that.
You could just raise it up a couple of points, you know,
That's what we want. Could hack the system.
with AI.
There you go.
I will pick it up then.
Okay, folks. I want to start by, I'm not going to pick on you guys, but there are two interrelated problems that came out after the quiz. One is, I think I mentioned I wanted you to write the name on the back, right? Or am I imagining this? Right? About half of you did not, which led to a second problem, which is when you look through the quizzes, if half the quizzes have no last name, you're having trouble finding your name because you don't know where you are in the alphabet. Which led to a problem. Around 11:30 at night last night, I got an email from somebody. I don't know what they were doing in the building at that time, but they said, I can't find my quiz and they're all out of order. I actually made a trip out at 11:30. Now I live right across so now kind of tough to get into this building after 11:30. To convince the security guard that I was not a threat. Now I went up and I resorted the quizzes, and then this morning again they were out of order. You know, this is, I think we know if we, and part of the reason for that is you don't, is the last, so next time, next quiz, when I ask you to write your name on the back, please do. There's one quiz that had not even a last name, it had just initials. I don't know whether you think your initials are somehow unique, but putting in initials is a terrible way to tell me who you are, right? It's a class of 300. You put two initials there. I have no idea who you are. Now, if in algebra, what's the rule? If you have one equation, you can have one unknown. I have more than one unknown because there are 12 or 13 people who didn't take the quiz, and now I don't know where to put you. So this is just for the next quiz. Write your name on the back. And for God's sakes, please don't mess with my alphabetical order when you're picking your quiz up, because you know, I know it's tough to sometimes find your quiz. You've turned it over, you're going backward, but leave it back the way it was when you're done, because it makes everybody else's job a little easier. Okay? So today we have the next step in intrinsic valuation, right? So remind me again where we are. We've talked about discount rates, cost of capital. We've talked about cash flows, free cash flow to the firm, free cash flow to equity. We've talked about growth rates, and we put closure with the terminal value. That's it, right? That's DCF. And when you discount cash flows back at the cost of capital, you come up with the value of the business. And then you got to get from there to a value per share for your company. For the next session or two, that's all we're going to talk about. How, once you come up with the value of the business, you get from there to value per share. I call these the loose ends in valuation because you don't pay much attention to them because you think you're done. So let's talk a little bit about the lead into these loose ends. Every one of your companies has a cash balance, right? If you're doing a firm valuation, that cash balance sits to the side while you're valuing the business. It's a free cash flow, you discount the cost of capital. And the rule is at the end of the process, you add the cash balance on to your value because it's not been counted yet. So I'm going to present to you an argument I've heard from analysts as to why cash balances hurt the value of a company. And you tell me whether there's any basis to this. So an analyst says, look, you know, Apple has $200 billion in cash, and it does. The cash is invested right now earning about 4.5%. That's well below Apple's cost of capital and what Apple earns on its other projects. And he says that makes cash a bad investment. Using that definition, cash is a bad investment then for most companies. What is the analyst missing This is actually a quote I pulled from an analyst.
Calculate the cost of capital. We don't weight cash into it, and when we look at our reinvestments, we look at non-cash assets.
But that still doesn't address the main question, right? His basic statement is a true one. The return on capital on cash is much lower than the cost of capital. But there's a much more direct way to answer that question too. I think you're on to it. Opportunity cost. What's the opportunity cost of an investment? Is what you can make on another investment, but complete the sentence of equivalent risk, right? What's cash invested in? Something liquid and riskless. The question I always ask people is, if you have cash in your brokerage account, and I do. So 3 days ago, I do this mopping up for me and my kids, and this cash sitting around, and I took the cash and I put it into 6-month T-bills. Liquid, hopefully riskless. Why hopefully? Who knows what the U.S. Treasury might do. I made about 4.5%. What did I say Apple's making on its cash? About 4.5%. You're earning a low rate of return, but a fair rate of return. If you earn what I would earn on a T-bill, you're effectively earning, it's a zero net present value investment. Cash earns a low return, but it's not a bad investment. Today, we're going to ask a follow-up question. Are there times where you might discount cash in the hands of a company, but it's got nothing to do with cash earning low rates of return? That's okay. Second, and this is more a test of your accounting. Let's see how many of you understand or remember your accounting. Companies often own pieces of other companies, big or small pieces. So let's say company A owns 60% of company B. Okay? And you do a valuation of company A. You take the earnings, the cash flows, you come up with a valuation of company A. How much of company B is in that value? You see what my question is? You got free cash for the firm, cost of capital. How much of company? 100%. You're saying that makes no sense. I agree. But what is it about the way accounting is done that leads 100% to be counted?
Dominating financial control of another company, you have to consolidate.
You have to consolidate. You have to act like you own 100%. I've never understood this. This is another one of those things in accounting I don't quite get. I own 60%. You're making me count as if I have 100%. What that means is if you value this company A all the way through, you've overvalued your ownership stake in company B, right? So to get back to your value, what do you need to do? You counted 100%, you own only 60%. You've got to take out the 40% that doesn't belong to you. Is there an accounting word for that 40% that doesn't belong to you? It is. It's called non-controlling or a minority interest. We're going to talk about how to deal with that because, in effect, you've double counted otherwise. Let's change the scenario a little bit. Let's suppose you own 10% or 5% of another company. And you do the same thing. You value company A all the way through. How much of company B is in there? Sure. Claire? I would like you to be telling you're thinking like somebody with common sense. Think like an accountant for a little while. Not that accountants don't have common sense, but perhaps they don't. You know, when you own 10% of a company, what you're required to do? You're required to keep it out of your financials. And after you've done your operating income, below the operating income, you bring in the 10%. So when you value a company with a lot of minority holdings in other companies, 5%, 10%, and you do a discounted cash flow valuation, you valued none of those cross holdings. Cross holdings are the component of valuation that almost everybody in this class struggles with. So in the second quiz is a cross holding question. Through history, it's a question where people have trouble because sometimes you're adding it back because you haven't counted it. Sometimes you're subtracting things out. Sometimes you're doing both. And as accounting gets messier and messier in how it deals with cross holdings, this problem is only going to grow. So we'll come back and talk more about cross holdings today in the class. So let me open up to the section. I know you've lost your way in the slides, so I'll tell you where we are in the packet. We're on slide 219, called tying up loose ends. Basically, it's about dealing with the fact that you tell me you're done and then you do all these things that actually undercut. Do you know how academia works? I'll tell you how it works. So, I work like 4.5 hours a week, incredibly hard. for about 15 weeks a year. I get the remaining 37 weeks off. And because I work so hard, I get every 7th year off with pay. It's like very biblical. You work 6 days, you get the 7th day off. Don't let any professor tell you how difficult their life is. Can't get any cushier than this. Right? So I've had, because I've been teaching a long time, 5 sabbaticals. You measure academic life in the number of sabbaticals you've had. This is about 2 sabbaticals ago. Notice how already I'm framing not 14 years ago, but 2 sabbaticals ago. Sabbaticals coming up. And usually people have big plans for their sabbatical. They're going to write a book, or do research, or go to another university. And this particular sabbatical had a singular objective. I wanted to have nothing to do for a whole year. The sabbatical first day happens. I'm a little ostentatious about the whole thing. I go to the local office supply store and I get one of those to-do things you can put on the wall. I bring it home. I put it right above the little cubicle area where I worked at home. And this was when all 4 of my kids were still at home going to school. So they all come down on their way to school. And I point to my to-do list and say, kids have nothing to do today. Piss them off no end. But they went off to school. And then I made my fatal mistake. My wife came down the stairs and said, "Han, I have nothing to do today." She said, "Really? Why don't you take the dog for a walk?" Take the dog for a walk. I come back, there's something on my to-do list. I'm foiled again. It says, pick up bok choy at the grocery store. I'll make a confession. I had no idea what bok choy was. I was too embarrassed to ask. I spent about 45 minutes wandering around. It says seafood, not there, meat. Ultimately, it turns out it's ugly looking cabbage. I find it, I come back home. There's another item on my to-do list. Pick up kids from school. And after about the 3rd or 4th item, I'm getting desperate. I want to do something to keep my wife off my to-do list. To show you how desperate I get an email from a magazine, or editor of a magazine called CFA Magazine, a magazine I'd never heard of. And he says, "Would you write an article for us?" My first reaction was, "I'm on sabbatical, I want nothing to do." But then I remembered I needed things to do to keep my wife off the list. So I said, okay. And then I write in big letters on the to-do list, write CFA article, cannot pick up bok choy kids, etc., etc. And I did write the article. I have to tell you, the only thing I've ever written in valuation that's got me hate mail. You know how difficult it is to get hate mail in this business? People don't write to me and say, "I hate you for using bottom-up betas," or "I hate you for," they don't feel strongly enough. Part of the reason I got the hate mail was the title for the article. It said, "Stop the Garnishing." And I was talking about this practice in valuation. We valued a company, and then you added 30% for control and 15% for this, and you knocked off 25% for illiquidity. And by the time you were done, you came back to the number you wanted to in the first place. And I said, you got to stop that. And I might have used the word arbitrary to describe the premiums and discounts, which pissed off a lot of people. So how come it's not arbitrary, it's based on restricted stock studies or whatever other crap they looked at. But one of the emails actually went beyond the insult phase and said, if you don't like the way we're doing these things in valuation, why don't you come up with a better way? I said, you have a point. I said, I have 11 months in my sabbatical. Here's what I'm going to do. Each month, I'm going to pick up what I call a loose end. And I'm going to say, if I were able to value this, how would I do it? Month 1 was on control. Month 2 was in illiquidity. So basically each month. So my plans to do absolutely nothing on my sabbatical kind of fell apart, but it became one half of one of my valuation books. The last half, the second half of the modern valuation is that sabbatical playing out. So I'm going to take you on a speedy run of those 11 months and talk about some of the things I had to deal with in terms of coming up with loose ends. So I'm going to start with cash and marketable securities, right? We know what every textbook asks you to do. Just don't play games with it. The 100 million cash, just add the 100 million on. I'm going to ask what I think is a provocative question. Are there companies where you see 100 million in cash in the hands of that company, where you might actually value that cash at less than 100 million? And conversely, are there companies where, so basically the 100 million in cash, you might attach a discount or a premium. What are the conditions under? So I want you to start thinking about that because that's where we're going to start. Second, I'm going to talk about cross-holdings. In a perfect world, how would you value cross-holdings? And then we're going to talk about the real world and the information limitations we have and talk about how to value cross-holdings. So you got the value of the firm, discounted cash flow value, add cash, and you got it cross holdings. And you look around, say, is there anything else I should be adding on? This is your last chance to bring in other stuff. What else can you add on to a discounted cash flow valuation? I'll give you a preview. You're a hotel company. You value the company as a hotel company. Can I add the real estate on which the hotel sits to my valuation? Start thinking about it, because again, that's going to be something we're going to have to come to deal with, because companies often have physical assets, other assets. What can I add on? What should I not add on? And what's the rule that I use? Once I come up with the value of the firm, I have to subtract our debt, right? Did we have to deal with what is debt earlier in the valuation in the context of estimating the cost of capital, right? This is a different question. What do I net out from the value of the firm? And maybe the rules are going to get a little different here, because this is my last chance to bring in anything else that worries me. Like what? Maybe there's a lawsuit hanging over the company, where if I lose the lawsuit, there's a small chance it could wipe out half the company. This is your last chance for those loose ends. Then once you value the equity, to get to value of equity per share, the routine, when I first wrote my first edition, you got the value of equity. Value of equity per share was trivial. You divide by the number of shares. The world has become a messier place. Why? Because increasingly companies use equity to compensate employees, either as options or with restricted stock. Either creates an issue, the former more of an issue than the latter, because I can't just divide by the number of shares. I've got to deal with those equity options and restricted stock to come up with the value per share. Those are the loose ends. Let's get the process rolling. Let's start with the value of cash. The rule again in every textbook is you have cash, don't mess with it, just add it on. Count it more carefully if you want, if it's currency, but it's cash is cash. And we're incredibly sloppy about the way we deal with cash and valuation. If you ask analysts, what do you do with cash? They have no idea. Just slip through it. If you do an equity valuation where you ask to take dividend discount model, cash kind of disappears somewhere in the game, right? So where did it go? So I'm going to start off with a very simplistic example, and I want you to help me figure out, with the example that I've given, why cash might matter in a company. So I'm going to show you 3 companies. They all have 100 million in cash. So there's no doubt about the cash being there. So that's not, fictional cash. It's actual real cash, $100 million. But here's where they're different. Company A has historically earned a return on capital of 10%. Its cost of capital is 10%. Company B has historically earned a return on capital of 5%. Its cost of capital is 10%. Company C has historically earned a 10% spread over its cost of capital. A and B are developed market companies. C is an Argentine company. I'm going to argue that in one of these 3 companies, cash is going to be a neutral asset. What does that mean? 100 million cash is worth 100 million, which is what we do in every valuation. In one of these 3 companies, you might discount the cash in the hands of that company. And one of these 3 companies, you might attach a premium. So you ready? Which of these 3 companies is cash most likely to be a neutral asset? They earn roughly their cost of capital. It's a blog company. What does a blog company do? It doesn't do good things. It doesn't do bad things. It kind of runs in place. But before you complain about blog companies, there's a fate far worse than investing in a blog company, which is, which of the companies would you discount the cash? B. And what is it about B that terrifies you?
The return on invested capital is lower than.
And let's say it in intuitive terms. What does this company have a history of doing? Stupid things. You're attaching a stupidity discount. You're saying these managers are so incompetent that they will find a way to waste the 100 million. It's not the cash itself, that's the problem. It's what the company can do with the cash. And the more bad stuff you've done in the past, the more of a discount you're applying. And in one of these 3 companies, you might actually attach a premium. And by exception, by elimination, what is it about company C that leads you to view the cash as a positive?
Because they have a high return.
That's part of it, right? They take good investments. But if you have lots of U.S. companies who earn more than the cost of capital, why wouldn't attach a premium to the cash?
Diversifying what industry?
No, that's a bad reason for paying a premium, right? So because then you can do all kinds of things. In the US, you know why we don't historically attach a premium to cash? Is because you have great investments. What do you assume you can do? Go out and raise capital. Why did I put the company in Argentina? Any Latin Americans here? Nobody wants to admit to it. Okay. If I say Argentina, what comes to mind? You're from Argentina. In fact, last time I was in Uruguay, they asked me what I thought about Argentina, and I said Argentina is having this eccentric uncle living in your attic, and he comes down every 2 or 3 weeks, and he's completely out of control, right? That's how Uruguay lives, because right next to Argentina. Argentina is a market where in the last 25 years, there have at least 5 or 6 times the capital markets have completely shut down. Let me explain what I mean by that. You can't raise equity, you can't borrow money from a bank, capital is frozen. Now do you see the advantage of having a cash balance in a market like that one? You can survive the next crisis. You essentially have, so in an Argentina, the only mistake I made is putting in Argentina, because I did this in Brazil, this session in Brazil once, and I asked this question, which of these 3 companies we attach a discount to? Like 85% of the audience picked the Argentine company. I said, what's going on here? Turned out the previous week, Brazil had played Argentina in a soccer game. Brazil had lost, and you can't trust these Argentines. Okay? So this has nothing to do with trust. It's a factor of capital market. So when you're in an emerging market, you have a cash balance. This might actually allow you to survive and live. So we're actually arguing that the market treats cash differently in different companies. Sounds a little outlandish, right? So I'm going to show you the results of what plays out here. It's not the cash itself that you're being punished for, it's what you do with the cash. So if you have a history of taking bad investments, I'm essentially going to punish you not because there's cash in your balance sheet, but because what you might do with the cash. And the worse your history, the bigger the discount is going to be. So as you look at companies with cash balances, there are good reasons for discounting cash and bad reasons. And here's the market number that I want to look at. It's one of the most creative I usually don't care much for academic research because they're asking questions that nobody cares what the answer is. And they give answers that only like 25 people care about. This was actually a paper that tried to ask a big question, which is, how much does the market value cash in the hands of a company? They took all US companies, and with a very clever way, they actually came up with an estimate of how much a dollar in cash is valued. So looking across all companies in the market, they found that across all firms, a dollar in cash is valued at $1. Good news, because that's what we do. But if you look at mature firms with negative excess returns, what does that mean, negative excess returns? Companies like Company B. A dollar in cash is valued at 69 cents. That's a mind-boggling discount. Think about it. You have a mature company with a bad history of 10 billion in cash. What do I value the 10 billion at? 6.9 billion. Let's say the management of that company calls you and says, oh, we're being underpriced by the market. There's this 31% discount that they're putting on our cash balance. What should we do? What's the most direct advice you should give them? Don't use the cash. That's why I'm punishing you. Give the cash back to the shareholders. Using the cash is actually going to reinforce. You can't tell them earn a higher return. They're incapable of it. Their business is not there. Give the cash back. You think they're going to listen to you? What are they going to say? We've changed. We're much better now. You heard of activist investors, right? Carl Icahn, Bill Ackman. You know what Carl Icahn's favorite target is? A company like this one. Because what does Carl Icahn do? He comes in and he says, you have 10 billion in cash, give back the cash. The minute you give that cash back, the 31% discount disappears. This is activist investing. We have to do very little to get that discount released. Last week, I was looking across the world. In fact, I just posted this on dividends and cash balances around the world. The part of the world where you get the lowest dividend payout is India. So I'll give you a contrast. US companies return about 77% of their earnings either as dividends or buybacks. India, the typical Indian companies, across all Indian companies, that ratio is 31%. Now, some of this is for growth, right? India is a big growth market. The other is that Indian managers, family group companies, like to hold the cash because once they pay the cash out, they don't control the cash. So why is the number so high in the US? What leads US companies to return so much cash? It's not because they care about their shareholders. It's because there's this constant pressure from activist investors saying, hey, give me the cash back. You don't need the cash. Corporate governance in India is essentially dead in the water in most companies. What does that mean? These companies are going to have big cash balances. Many are family group companies where you don't trust the company with the cash. So guess what these companies get priced at? 3 times earnings, 4 times earnings. The families complain that they're being underpriced. But who can blame investors for discounting the cash in the hands of the company? You need that push of corporate governance for the cash to be released. At the other end of the spectrum, if you look at high growth firms that earn well above the cost of capital, there's actually a premium attached. If you're a young tech company, I want you to have a cash balance. Why? Because I want you to survive, to deliver on your potential. So when you look at companies, you can already see differences in how cash gets treated based on the company. You have a question?
Does the discount on cash also depend on the tax rate? You can never get $1 to an investor, right?
Why?
If you pay a dividend, they'll have to pay taxes or do
Do a
buyback.
buyback, you get but you do a buyback, you get capital gains. But do you get capital gains? So only the people who sell their shares back get taxed. The way capital gains works is you can defer it until you sell it. So in a sense, I can reduce it. But one way or the other, the cash ultimately has to get to you, right?
Tax.
But no matter when it gets to you, there's a tax issue, right? So this is all you're doing is delaying the issue. You can't make it go away. So that alone can't explain why you're holding on to cash, because ultimately you got to figure out a way to get that cash to me. Yeah.
Always leave that.
It's always out of it because there are, remember, bulk of the money in US markets is tax exempt. Pension funds, so a lot of money is basically not driven by taxes. Now I'm going to do a little tangent here. Question? Yeah.
You mentioned that we're adding cash back, so even if you're adding it at a discount, doesn't it still improve the value?
It increases the value. It doesn't improve the value. It's cash, right? So it's not as if you're doing the company a favor. Adding the $200 billion to Apple's value is not doing them a favor. It's actually counting an asset that is the easiest asset to value. No.
Pull the cash out, discount it, take it against value.
That's basically what you would do in Apple. I'm not going to put any pressure on Apple because I don't think there's any discount on Apple. That's a good point to ask. Why do you think Apple's not being punished for having such a big cash balance?
High return on equity and history of returning money to shareholders.
That is part of it. How many big acquisitions has Apple made in the last 20 years? None. They bought Beats, but I think that was like petty cash for them. Of 5 billion. Who's going to notice 5 billion even leaving the company? They have 200 billion in cash. You know how much, if you think about how much discipline a top management has to have to not spend the cash? I think they put a moat around one infinity loop to keep bankers out, right? Because every banker is out there saying, do I have a deal for you? In the last 15 years, I've seen people say that Apple should buy Netflix, Apple should buy Tesla, Apple should buy Greece. But you have 200 billion, you can buy entire countries. And you got to give Apple credit. They haven't done it, and that takes disciplines. As a stockholder, what are you saying? They have 200 billion cash, but Tim Cook is not going to buy some big company for 200 billion because that's not who he is. That's basically what trust is based on, is you look at a history and you say. So when companies do things that breaks that trust, you start to see discount show up. 3 years ago, Facebook was in trouble. Remember what triggered the trouble? What did Mark Zuckerberg do that dug the company into a hole? They're out of it now. We'll talk about what they've done to get out of the hole. What did he announce with a lot of fanfare that basically... No, this is the more broadly the metaverse. Remember, he told the world he was going to spend $100 billion in the metaverse. The VR is part of that metaverse. And people said, what exactly is the metaverse? How are you going to make money? And he said, I haven't thought about it, but we'll spend $100 billion first. And he was very caught up in, I am a tech guy. I know what I'm doing. And markets finally said, you know what? We don't trust you. Stock price collapsed. I'll wager Facebook's cash balance was being discounted then. It was discounted to the point of, it was actually discounted to zero. Because the assumption was they will find a way to put this money into this metaverse. We have no idea what it is. How did Facebook get the trust back? First, they walked back from the metaverse edge. So you notice that he doesn't do this metaverse crap anymore. Right? Which is good. Most managers don't listen. He started returning cash in the form of buybacks. And that's all management can do, is listen to shareholders saying, you don't trust us. Let me do something to kind of earn that trust back. You can't talk the trust back. You can't tell shareholders, trust me, you got to do things. So Meta is actually a great example of trust lost and trust regained and how difficult it is for companies to retain that trust. Now, everything I've said about cash, I can say about another group of investments as well. Cash should be an easy asset to value, right? It's right there. And I'm discounting the cash because I don't trust you with my cash. You've all, you're all familiar with mutual funds, right? So most mutual funds are what are called open-end funds. What does that mean? You send your money to Fidelity Magellan. What they do is the fund gets larger. Everybody gets an equal share of the net asset or a share-based. So open-end funds basically are money going in, invest in stocks, and the net asset value just flows through to you based on how many shares you own. You know what a closed-end fund is? A closed-end fund is a fund where you buy shares in the fund. The fund invests in publicly traded stock. So when you look at its balance sheet, you'll see Apple, Google, Microsoft, etc., because that's what they've invested in. If I asked you to value a closed-end fund, it should be the easiest of all valuations to do, right? Every asset is publicly traded. You take the market cap, you add them all up, you come up with a value. And if you divide by the share count, you should get the value per share that the stock is trading at, right? For 50 years in finance, research has come up with this, what's called a closed-end fund discount. What are they talking about? If you look across all closed-end funds, a typical closed-end fund trades at a discount of about 15 to 20% on its net asset value. If you own $100 million of stock, publicly traded stock, the fund trades at 75, 80, 85 million. There are a few closed-end funds that trade at premiums, but it's called a puzzle. But I don't think it's a puzzle, and here's why. Okay. Let's assume that a typical closed-end fund trades at an average risk portfolio, which is a beta of 1. And let's suppose the cost of equity for a beta 1, risk-free rate times equity risk premium, is 11.5%. What's the history of active investing that you deliver the market return or deliver a little less? Historically, active investors have delivered less than the market for whatever reason. Let's say this fund consistently delivers about 0.5% less than it should. Why? You got to pay all those analysts and the people in the building. They're not adding value. It's got to come out of your return. How will this affect how much you pay to invest in the fund? So you invest $100 in the fund, you need to make 11.5%, right? But you're making only $11. Forget growth. Keep growth out of. Can you tell me what the market value of this fund will be if you earn $11 every year in perpetuity and your cost of equity is 11.5%? What's the value of perpetuity? You take the cash flow, you divide by the discount rate, right? You take 11 and divide by 11.5%, you get like $94. You're saying, so what? There's a 6% discount on the value. The discount is being applied because you think this manager will keep taking investments that earn less than the required rate of return. There's your answer to the closed-end fund discount. The closed-end fund discount exists because we don't trust closed-end fund managers to deliver the expected return. But then let's look at the few closed-end funds that trade at a premium. If the closed-end fund discount is explained by the fact that closed-end fund managers are expected to underperform the market, you see what causes some closed-end funds to trade at a premium? You expect that manager to beat the market. It must be a very special manager, right? I'm going to show you the picture of the most famous closed-end fund manager on the face of the earth. Who am I talking about? A guy called Warren Buffett. It's not called a closed-end fund. It's called an insurance company, Berkshire Hathaway, where Geico brings in capital. He invests it for the closed-end fund. And here's what Berkshire Hathaway has looked like over its lifetime. Don't worry about all the red. The red is actually the market cap. The green, if you look at Berkshire Hathaway's assets, it's all publicly traded companies. Washington Post, Coca-Cola. So if you look at the green, it's a book value. The market value has been consistently above the book value. Some of it can be explained by having a really good insurance company. But if you compare the price to book ratio for Berkshire Hathaway with the price to book ratio for a typical insurance company, historically, Berkshire Hathaway has traded a premium. There's been a premium in the closed-end fund. Why? Because you trust Warren Buffett to earn more. But that difference seems to have, if you go across time and you look at the difference between Berkshire Hathaway and insurance companies, that difference, especially as you get over time, seems to be getting smaller. And in 2023, it completely disappeared. Berkshire Hathaway now looks like a typical insurance company. So what's happening here?
He's pretty old.
It's exactly. Mortality is reminding you. Now, you got this reminder last year when Charlie Munger died, right? I know it sounds morbid, but if you're going to see Berkshire, Warren Buffett at a meeting, get there soon. Like this year, right? It's in a month or so. I don't have any crystal ball. I'm not saying he's going to die next year. But in 93, the clock is ticking, right? Maybe he'll live to be 115 like that, the oldest person on the face of the earth. But the market is also, sometimes you got to listen to what Warren Buffett says. And 10 years ago, what did he say? That he wasn't going to be the one picking stocks anymore at Berkshire Hathaway. He actually turned over the management of the fund to Todd Combs and Ted Wexler, the two. And they're very good managers, but they're not Warren Buffett. This has now become a very average closed-end fund. And what do average closed-end funds do? They trade at roughly whatever you're going to see as the assets. This is now trading as a very good insurance company without that premium you got with Buffett leading. So whatever we said about cash, you're going to see play out with things like closed-end funds. Yeah.
Is the value of common equity
That-
for a company like Berkshire?
It's this market. Exactly, right? Because it's required to mark to market. So if you bought Coca-Cola 10, so everything on the books is mark to market. So one way to think about buying Berkshire Hathaway shares is you're buying Coca-Cola and paying a 20% premium on the stock price. Kind of mind-boggling when you think about it, but that's what Warren Buffett brought to the company. Right? So any questions about the discount premium, either cash or closed-end funds? You're effectively, as an investor, building in that expectation. Let's talk about cross holdings. As I said, this is to me the most difficult part of valuation because it's so messy. Step back and think about the three ways in which accountants classify cross holdings. If you own 3, 4, 5% of a company and you take no role in how the company is run, it's called a minority passive holding. And with a minority passive holding, here's what you're required to do. On your income statement, you're required to show the dividends you receive from that holding. And on the balance sheet, you have to show what you originally invested to get that holding. In the late 90s, SoftBank was then a young, upcoming Japanese company. Masa Son was a much younger man than he is today. But the legend of Masa Son was born the day he bought Yahoo as a venture capitalist in the early 90s. And that venture capital investment had become 70% of SoftBank by the time he got to 1997. He owned like 5, 6, 7% of Yahoo, but the stock had gone up. But if you looked at SoftBank's financial statements in 1997, that Yahoo holding was classified as a minority passive investment. So if you look at the income statement for SoftBank, what is it? What are you going to see from the Yahoo holding? What did I say you have to record? The dividends you receive, right? You know what dividends Yahoo was paying in the 90s? Zero. You'd have seen nothing. You're saying, okay, it'll be on the balance sheet. If you go to the balance sheet, you'd have seen a $50 million investment reflecting the original VC investment. That was, the market value was $7 billion. The worst possible scenario, of course, for you is minority passive investments because there's nothing in the financials that's going to help you. One step up. A minority active investments. A minority active investment, let's say you own 20% of a company. Here's what you're required to do. Yes, you're required to use what's called the equity approach. So in your income statement, you have to show 20% of the net income or the net loss. So it's a little better than dividends, but below the operating income line. Key is below the operating income line. And on your balance sheet, you have to show what you originally invested plus or minus 20% of the retained earnings in. So it's like an updated book value. Not great, but much better than minority passive. And then you get to the 60% holding. It's classified as a majority holding, and accountants lose their minds. Own 60%, you have to consolidate. So what does that mean? When you do revenues for your company, you have to count 100% of the revenues. And you say, look, I own only 60%. The accountant waves you off. You get to operating income, you act like you have 100%. You say, I own only 60%. The accountant waves you off again. You get to the asset side, you count all of the debt, all of the cash. And each step you're saying, but I own only 60%. The last moment the accountant wakes up and says, you own only 60%. That's what I've been trying to tell you all this time. You don't own 40%. Exactly. You got to subtract it out. Therein is a minority interest. It's a residue of consolidation. So what's the first thing you need to do if your company has cross holdings? Figure out how they've been accounted for. And with joint ventures, this process become even messier. So if you see on your balance sheet cross holdings, go to the footnotes to see how they're accounted for. They have to tell you what the accounting system is, because only then can you even take the next step. So let's say you figured out the accounting. In a perfect world, here's how you'd value cross holdings. First, you'd value the parent company standing alone. You know what I mean by parent company? When you have a consolidated company, many companies also report what I call parent financials, which is just the standalone parent company. If you have those financials, value the parent company separately. Then take each cross-holding and value each cross-holding separately, whether it's 5% or 60%, you don't care. So each cross-holding you value separately as a separate business. Then you take 5% of the first one, 60% of the second one, 35%, and you add them all up. In a perfect world, that's what I would do. I almost never get a chance to try this out because in the real world, it's really difficult to do this because you need full financials for each of the subsidiaries and you have to do a full valuation. So I'll tell you when I got closest. You're all familiar with Yahoo, the company, right? It's now no longer a company, so you might not be familiar with Yahoo as a company. The name lives on, but Yahoo, the company, is kind of moved on into the great beyond. This was a valuation I did right after Marissa Mayer, who's employee number 11 at Google, was brought into Yahoo and asked to turn the company around. Most dangerous thing you can do is bring in a new CEO and turn a company around. And here's why. Because in 2014, if you look at Yahoo's basic operating business, it had a search engine that nobody searched on, and an email program that I think only people over the age of 70 use called Yahoo Mail. It's a bad business. It's shrinking. And only in the minds of the fevered few was there any chance that Yahoo was going to make a comeback and replace Google again. So I valued Yahoo with the best possible assumptions I could make. I came up with a value of about $4 billion for Yahoo. Stock was trading at 39 billion. Yeah, that's a really overvalued stock. It wasn't, because there were two cross holdings that Yahoo had that effectively made up the difference. So the first was a 35% of Yahoo Japan, which is a standalone company. And for whatever reason, the Japanese still use Yahoo. Don't ask me why. And you could value it, full financials. So I was able to value it separately. And it also owned 21% of a then very young, privately owned company called Alibaba, which was just on the verge of going public. And the nice thing about just being on the verge of going public is I had filed the prospectus, I had full financials. This was a case where I could do intrinsic valuations of all three companies, and I did. So I valued Yahoo's base core business, parent business. I valued Yahoo Japan because it's a separate publicly traded company and took 35% of that equity value. I valued 22% of Alibaba. And that's a huge number. And you take 22% of that, you add the three numbers up, you come up with the total value of the company, including the cross holdings. I did mop up a few loose ends because if you try to sell these cross holdings, you're going to pay a tax because Yahoo's investment in it. I took into account the tax. The value that I got per share was about $41, adding up the intrinsic valuations of these companies. Why was I able to do it? Yahoo is a publicly traded company, had their financials. Yahoo Japan is a separate publicly traded company, had their financials. Alibaba had filed its, I couldn't have done this before the IPO because the Alibaba numbers were kind of diffuse. I didn't know what they looked like. I was able to do it because at that point in time, I had access to all three. She's saying, why can't I do this for every company? I'll tell you a story to illustrate how messy this process can be. Late 90s, I was writing the second edition, I think, of my investment valuation book. It was valuing a Japanese company. And when you value Japanese company in the 1990s, you're always teetering on the edge of disaster. Why? Because the Japanese risk-free rate was so much lower than the risk-free rate elsewhere in the world. That if you took any of the numbers you usually use in the rest of the world, like growth rate in perpetuity, put in a Japanese company, it would blow up. So I was very careful. I was very proud of myself. I finished it. I'm patting myself vigorously on the back. And then I take a look at this company's balance sheet. And I wish I had not. They had 227 cross holdings. So if I were one of these careful analysts, I'm not, but if I were one of these careful analysts, wanted to do things right, my job is laid out for me, right? What do I have to do to value this one company? I have to value 228 companies and take 2% of company. There's zero chance I'm doing that to begin with. But let's say I went down that route. I would still have not been able to do it because 60 of the companies were public. I could have done, I could have got the other 167 were privately owned with zero information provided. So I called the investment relations officer for this Japanese company. It's an incredibly intimidating lady. She picks up the phone, says, "What do you want?" I said, "You know what, I'm valuing a company. It's not for an expose. Can you give me some information on your cross holdings?" She said, "I cannot give you that information." I said, "Why not?" She said, "It's proprietary." Terrifying the way she said the word proprietary. So I said, "What if I bought 1,000 shares in your company and called you?" She said, "It'd still be proprietary." I said, "That doesn't make any sense to me. I'd be part owner of the company. You're refusing to tell me what I own." She says, "You have a point, but it's still proprietary." So I get ready to hang up the phone, banging my head against a brick wall, right? She said, wait, I do have something I can tell you about these cross holdings. So I said, maybe she's going to give me some information on revenues or earnings. I said, what? She said, "I cannot give you specifics, but these cross holdings are worth a lot." I said, "Look, I'm sitting here in front of an Excel spreadsheet. I have a cell right next to cross holding. I've entered the words LOT, but I seem to be getting error messages right below. Can you tell me how many zeros there are in a lot?" She didn't answer. But that cuts to the heart of the cross holding culture, right? What do managers do? They hold up a brown paper bag. Say, "Trust me, it's full of cash." Can I look in the bag? No. But I'll tell you how much. That's what we allow these companies to do, right? Tell us on a balance sheet what their cross holdings are worth. Do you really believe SoftBank when they say their Ola holding is worth X billion dollars? I know they got Ernst and Young or Deloitte to come in and do their work for them, but you're basically taking them at their word. So I'm going to give you some approximations I use because there's really this isn't a problem with knowing what to do. The information is not there. So here's what I do when companies have cross holdings. I know the book value of these holdings. Most companies use the equity approach. If you tell me what business you're in, let's say you have a chemical company in your cross holding. On my webpage, I actually have price to book ratios by industry group. Let's say a typical chemical company trades at 1.5 times book value. You see where I'm going to go, right? You have a $100 million cross holding. It's a chemical company. It's a book value. I multiplied by 1.5 to come up with. You think that is so simplistic. Guilty as charged, but given the information I have, it's better than using book value. I'm adjusting the book value. If your company is publicly traded, the Japanese companies, the 60 companies that were publicly traded, I cheated. You know what I used as their value? I took the market price. Why is that cheating? Because in intrinsic value, you're supposed to question the market price. But I said, look, you have 60 companies. Think of how much time it saves me to take the market price. The times you have to be cautious about cross holdings is when you have a cross holding that is big and a big chunk of your company comes from that cross holding. SoftBank, for the last probably decade, what's the biggest holding there? Like Yahoo, they were an early investor in Alibaba. They had 25% of Alibaba, which they got as a venture capitalist. For a while there, a third of SoftBank's value came from the Alibaba holding, which means if you're valuing SoftBank, there's no way around the fact that you have to value Alibaba as well, because otherwise you're just going to get the market price feed through. What do you think about Microsoft's holding of OpenAI? Right? You could trust the markets, which tell you OpenAI could be worth 100 billion, 49% of 100 billion. That's a big cross holding. This isn't penny change. You're going to have to face this even with US companies now, because these cross holdings can show up. So in the approximation game, you're basically pricing cross holdings. So I actually took Yahoo and I said, if I didn't want to do an intrinsic valuation, I was too lazy. I could price Yahoo, the parent company, applying a multiple. I use the enterprise value to sales multiple. And basically, the only reason I use EV to sales is it's kind of less affected by accounting. And I have a US company, a Japanese company, and a Chinese company in my mix. I'm worried about whether the EBITDA and the EBIT are comparable. So back of the envelope, much easier to do an intrinsic valuation, but you're pricing the three pieces there to come up with the pricing of the company. The case of Yahoo turned out to give me an answer very similar to my intrinsic valuation, but the answers could have been very different. So any questions on cross holdings? Okay. Which brings me to mopping up. So you've valued, taken the cash flows, discounted the cost of capital, come up with the value of the operating assets. You've dealt with cash. And I will leave it at that, right? Either at face value or at discount. You've dealt with cross holdings as best as you can. You get ready to wrap up. And then you take a look at the balance sheet and you start questioning yourself about what? Should I be adding that item? How about that item? Let's start with the items you should never be touching. You see goodwill on a balance sheet. Don't add it on, right? There's nothing there. But let's say you see brand name on the balance sheet. Increasingly, European companies, accounting has brought brand name on. Should you add brand name onto your discounted cash flow valuation? What about physical assets that the company already owns? Refineries, ships. How do you decide what you should add on and what you should not? Lisa, help me out here. I valued a company. I have all these things I'm looking at the balance sheet. What is the rule I use to decide whether I should be adding something on or not, or just ignoring it? If it's in your cash flows already, you've counted it, right? That hotel example that I gave you with the real estate, I can't value a company as a hotel company and add the real estate on top of it because I'm double counting. I can't value JP Morgan Chase and add 277 Park and 270 Park or whatever other, they like own like 6 buildings in the city. I can't add that on because who's sitting in those buildings? People, right? Traders, bankers, from whom I'm getting the income and the cash flows. You cannot double count an asset. So what are you looking for? Are assets that you haven't counted already. Brand name, not on the table because brand name gives you pricing power, margins, cash flows. Most of the things you see on the balance sheet you've already counted. So don't start to add things on. And this is one of my fears with fair value accounting. The temptation is going to be there, right? Because they're going to keep putting items on. So use that rule. Have I already counted? If you have, ignore it. What have you not counted yet? Well, it has to be a truly vacant asset, right? You're saying, what if I have a piece of land where I expect to build a factory 5 years from now? That's in your cash flows because you will have less reinvestment because you own the land. It's got to be a truly vacant asset. Like what? Maybe your CEO likes to collect Picassos. The guy who ran AIG, 20 years ago, he was a long-time CEO. He liked to buy fine art, hang it all over the offices, belong to the company. The problem is, how the heck do you get into the office and check how many Picassos they own? But technically, that is a truly vacant asset. Yeah.
What about like a trademark?
Work it through. What do you do with the trademark or a patent?
Sells it.
Is it in your cash flows?
Yeah.
Yeah, right? That's the rule, right? If it's in your cash flows, it's off. Yeah.
Aren't patents more like real options?
Not if you've counted the cash flows in already. Right? You did the cash flows for the next 10 years. Tell me, when you made those projections, did you assume that some of these trademarks and patents would be used? If you did, you can't bring the real options argument in yet. If you did not count it in, see, the rule then gets passed, right? You didn't count it in. That's why I said my question always is, what have you already counted in? So I'm going to give you an example of a truly vacant asset that's basically a little off color and off the beaten path. There's a Michael Price fund in the MBAs have. I think you have an analogous smaller fund. The Michael Price fund was seeded about 25 years ago by a guy called Michael Price, obviously. That's why it's called the Michael Price fund. He just sold his business. He had a mutual fund business to the Japanese, peak of the dot-com boom, and he got about $2 billion. And when NYU notices that you have $2 billion, God help you, right? Because you're going to get like 50 calls from deans and deans over deans and deans on top of deans. And what are they trying to do? Get some of your money. They'll make you feel like you're the center of the universe. They'll name an entire plaza after you. Maybe bathrooms will be named after you. I don't know what they will do. No. So they decide, no, $2 billion, Michael Price, we're going to approach. And they came to me and said, will you go ask Michael Price for some money? And I said, not in this universe. I don't like to ask money for universities because I wouldn't give money to a university because I know where the money goes. It's not going anywhere productive. They said, but please, please, can you go ask because we want to seed this fund that MBAs are going to run. And I said, I'll make a one-time exception. So I was part of the team that visited Michael Price. We convinced him to give like $10, $15 million. Not a huge fund, but that fund is still in place. Every year, 10 MBAs get picked into this group. They run the fund. They pick stocks. They make pitches to each other. I have zero official involvement with the fund, but almost everybody who's been in that fund has gone through my class. So when they want to try a pitch out, guess who they try it on first? I'm like the target number one. I've got to hide because somebody would say, I want to try a pitch out, see if it works. So I'm sitting in my office, minding my own business, when this person who was in that Michael Price fund, just like 2008 and 9, pops into my office, guy I never liked, kind of pushy, aggressive guy. Investment banker from birth, I think, basically. It's kind of built into his. He says, I'm facing a conundrum. I very quickly turned to my computer, type in the word conundrum. It turns out he was confused, but I liked the word. I said, what's your conundrum? He said, my conundrum is I'm valuing Playboy. And I said, I don't see a conundrum yet. He said, I valued Playboy at 240 million. It's trading at 300 million. I said, I don't see. I managed to get the word conundrum into every sentence. I still don't see a conundrum. Don't buy the stock. And he said, here's my conundrum. There is one big asset that Playboy owns that I haven't counted as part of the 240 million. You know what he was talking about? Don't get your mind in the gutter, right? So keep it above board. It's not the clubs. It's not the. What is it? It's a mansion. If any of you are from LA, the Playboy mansion is one of the most expensive pieces of real estate in LA. It sits on acres of land worth $150 million. Then you see what his conundrum was? Playboy technically owned the mansion. That $150 million is not in the $240 million value. He said, can I add it on? And I said, technically, yes. But there's one problem. There's an 80-year-old in a bathrobe hanging out in the mansion. You know who's living in the mansion? Hugh Hefner was still living in the mansion. I didn't think it would be great PR to throw Hugh Hefner out on the street, right? I don't think he owned anything but bathrobes. I think at that stage he lived in a bathrobe. So he said, what should I do? I said, check the actuarial tables. So what am I checking for? How long 80-year-olds in bathrobes who surround themselves with 27-year-old playmates tend to live? Stress level, heart attack, waiting time. Let's say it's 5 years. What's the next step? Take the 150 million, discount it back 5 years, be fancy, use a caustic capital real estate if you want, add it on. I forgot completely about this conversation, go back to my business. Few years later, I open up the Wall Street Journal and Playboy has pulled off something I never thought they could. They sold the mansion with Hugh Hefner in it. I'm not kidding. This guy, Darren Metropolis, buys the mansion for $250 million, and the condition was that Hugh Hefner would live in the mansion till he died, and then Darren could move in. The second this happens, think of what you see on Playboy's balance sheet. What was this asset that never showed up is now $250 million in cash. That's what you're looking for as a truly vacant asset. Things you haven't counted yet. So when you think about what else should I add on, that's basically the pathway you go. So we talked about cash, we talked about cross holdings, we've talked about whatever else you add on. Let's make a pause here and think about what makes companies difficult to value. Each of you has picked a company. Some of you, even within your group, will have an easier time than others. And to see why that is, let me give you two companies. They look exactly the same in terms of numbers. Same growth rate, same cash flow, same return on capital. So all the financial numbers look the same, but here's where they're different. The first company is in a single business. The second company is in multiple businesses. The first company has very simple very simple holding structure. You see exactly what they own. The second company has created a very messy holding structure, special purpose entities, cross holdings. The first company is transparent accounting. What does that mean? You read the accounting statements, you know exactly how much money they made, what they own. The second company has opaque accounting. You know what opaque accounting is? You read the financial statements, they claim to be in English, but they're really in legalese, which is a version of English that only lawyers can understand. You read 200 pages, you have absolutely no idea what the company did. So two companies, numbers look the same. One is a simple company, the other is a complex company. Think like an investor. Which of these two companies would you value more highly? The simple company, the complex company? I would too. How many of you would value the simple company higher? Okay. How many of you would value the complex company higher? It's okay. Okay. You open up my book and you start plugging in numbers. What's the value you're going to get for both companies? The numbers are the same cost of capital. You're going to get the same value. I'll tell you when this became something that was a topic of conversation for this class. In the late 90s, a company called Tyco had an accounting scandal and lost 70% of its value. I'll tell you what Tyco did. It was a conglomerate that grew through acquisitions. The accounting scandal comes out. The accounting scandal was they hid a lot of bad stuff behind the accounting debris, and goodwill and restructuring charges. The whole thing blows up, loses 70% value. But that's not the story. When Tyco lost 70% of its value, GE lost 15% of its value. GE at that time was the most valuable company in the world. You're saying, why would you punish GE? What did I describe Tyco as? A conglomerate that grew through acquisitions. You know what GE was? A conglomerate that grew through acquisitions. Investors were saying, we were fooled by Tyco because they used this. How do we know GE is not doing this to us? So in class, somebody says, clearly this is an issue at markets. We need to bring complexity into valuation. What should we do? And I said, framework is very simple, right? To bring complexity into valuation, there are two questions you need to address. One is, how do we measure complexity? You can't say, I'll know it when I see it. The second is, how do you convert it into something in your valuation? Cash flows, growth, risk, discount rates. So I said, let's start thinking. So I said, I'll come back with a measure of complexity. And I came back with my first measure, and they were not impressed. This was my MBA class. I just counted the number of pages in the 10K and the 10Q. I know, incredibly simplistic. Let me ask you a question. If you wanted to avoid a company in this group as a company you want to value in a semester, which company are you going to avoid like the plague? 1,026 pages to tell me what happened in 1 year. This is War and Peace. It takes you 1,000 pages to tell me what happened last year. You one heck of a screwed up company, right? And it's by design. What did Citigroup do in the previous decade that led to this? The name itself should have given it. Citigroup used to be called Citibank, and the group came from Travelers Group. In the late 90s, John Reed, CEO of Citibank, stood next to Sandy Weil, who was the CEO of Travelers Group, and he said, our objective is to create the greatest financial supermarket in history. Bank, investment bank, real estate company. Companies often have these, which is fine, but this is the side effect. You create an incredibly messy company. So I show this in my MBA class. My MBAs look at me and say, we're not paying at that time 150,000 to count pages in a 10K or 10Q. We want something more sophisticated. I said, you're right. I'll be back. Yeah.
The really dumb part of this is like find a portion of words to text. So they say like
With AI now, you can actually create, you can go through text and AI will give a score of, is this 5th grade level, high school level, or is this a level that nobody even with a PhD can even understand, right? So you can actually come up with complexity scores. At that time, we didn't have that. So they said, we'd like something more sophisticated. I said, what was I thinking? Of course, I'll be back. This is the advantage of having, so Wednesday class, I wasn't back till Monday. So I came back with what I call my valuation shit list. This is it's obviously a term that's in wide use, a term I concocted. It's all the things that bug me when I value companies. Don't even try to read the list. It's basically a very subjective list of all the things that bug me when I value a company and how much they bug me. I'm capable of turning anything into a spreadsheet. My daughter, when she was looking at colleges, was very indecisive. Now, this is her general life. She can't pick between two desserts. No, colleges, of course, was this traumatic exercise. How the heck do I pick? So I actually built a spreadsheet where I said, go through. She ignored the spreadsheet completely, but I'm capable of turning anything into a spreadsheet. So I said, look, what are the things that bug me when I value companies? I'll give you a few examples. A company that claims to be geographically diversified but doesn't tell you where. So why do you bother telling me you were diversified? Or they tell you where, but you don't recognize any of the parts of the world they're listing. I still remember doing a valuation of BMW long time ago. And they have North America, South America, Europe, then they have Oceania. And I'm trying to think back to my geography class. Africa, where the heck is Oceania? Is it like the lost continent of Atlantis? So I called the investment relations officer of BMW. I said, can you tell me where Oceania is? He said, well, it's Australia, New Zealand, and Indonesia. I said, what do they have in common? He said, they're by an ocean. I said, really? That's your definition of Oceania? If I use that definition, 80% of the world is Oceania. And what am I left with? Latvia and a few other landlocked countries? But you see, by bundling together Indonesia and Australia, you see the problem they've created? What equity risk premium do I attach to it? Because those are very different risk countries. So I took a list of things that really bug me, how much they bug me, and I created a score. The higher the score, the more complex your company. I come back to class and I present this and say, is this better? And they say, yeah, this is why we came for an MBA. I said, there's one small catch here. To get the score for Citigroup, what do I need to do? Read 1,026 pages. I said, I'm not doing that, but each of you has a company to value this semester, right? They could see the train coming at them down the tracks. Too late to get out of the way. They said, yes. And I said, this semester, in addition to valuing your companies, I'd like you to come up with a complexity score for your company. They bitched and they moaned. But what choice did they have? They should have just stuck with my number of pages. That semester, the only semester I've asked people to compute, they did the complexity scores. But there were some very interesting findings. First, they found almost no correlation in company size and complexity. I assumed that larger companies, but there was no correlation. Small companies could be complex, large companies could be simple. Walmart is a very simple company. Palantir is a very messy company. Second, they found that emerging market companies were about 20% more complex than developed market companies, primarily because of cross-holdings, a lot of family group companies. Third, they found that any company that grew through acquisitions was 30 to 40% more complex than companies. If any of you are working with companies to do acquisitions, you're going to run into this. You're going to see items on the balance sheet like goodwill, items on income statements like restructuring charges, which throw everything off. And finally, they found that any company with a capital arm, a financing arm, was about 50% more complex than a company without. What am I talking about? GM, GMAC, Ford Capital, Volkswagen Capital. You have a bank embedded in a company. And you're told, oh, trust us, with the Chinese walls around the bank, all the debt is in the bank. How the heck do I know? So there were 300 companies that you got complexity scores for. The most complex company. Think about all the pieces that go into place, right? First is the company is in many businesses. There's a financing arm. It goes through acquisitions. If you were designing a company in a torture chamber for analysts, it would be GE. GE then was in 26 different businesses, grew through acquisitions. It had the highest complexity score. The lowest complexity score was actually an Indian company called Infosys, which at that time, it's completely direct. You could read its income statement, you knew exactly. So this notion that emerging market companies have to be more complex is not true. Often CFOs hide behind it, but it turned out to be a very simple company. So when you look at your company and you're pulling your hair out, you're saying, I want to punish this company for being complex, for making my life difficult. I'm going to give you a few ways to do it. But you can already see complexity can come from the outside. And I'll tell you one macro force that has made every company more complex. You take an annual report from 50 years ago, go back and see if you can pull off something. It used to be about 20 to 30 pages. There used to be financial statements. There'll be a little statement from management. Pick up the annual report now, the 10K, 250, 300 pages. Why? Because accountants are trying to be helpful. Every time accountants add layers, it just makes financial statements more complex, more difficult to make sense of. And if you add on additions for ESG, another 100 pages, and sustainability, another 50 pages, you know, I call this disclosure diarrhea, where more and more stuff gets reported, and you get less and less informed as you try to deal with that. Yeah.
Was there a correlation between, sorry,
It was very high. So at the end, I said, you guys should have stuck with the number of pages. It turns out the number of pages is actually a very effective measure of complexity. Now it's no longer number of pages because it's sometimes it's just file size. So you could probably check to see how big the file is and make your judgment. But if you print off a PDF, you can actually see the number of pages. Yeah. That's a good question, which is why would companies make themselves more complex if they're going to get discounted values, right? First, is that always the case that we discount the value of complex companies? In good times, we ignore it. That's the nature of good times. In the 1990s, boom times, you could be a complex company and punish you. When do you get aware of complexity? Is when things turn bad. Chinese companies are complex. But as long as China is growing 8, 9, 10% a year, you look the other direction. There's too much growth there. It's as growth comes down that you start thinking about complexity, because that's when you worry about it. Second, some complexity is by design. It's by management not wanting you to know how well your capital is being deployed, right? So a lot of family group companies, they build the complexity as a shield for outsiders even knowing because if you don't know how the money is deployed, you can't ask questions like, that's a bad investment, that's a good investment. So a lot of complexity is self-imposed because people trade off that control factor for the loss in value, and they're okay with it. Which brings me to the final piece. If you've measured complexity, how do you bring it into valuation? Remember the 8 proposition? For something to show up in value, where does it have to show up? Either in the cash flows or the discount rate. So let's talk about the ways in which you can bring complexity into the cash flows. One is you can haircut the cash flows. What does that mean? If you have a complex company, you take the expected cash flows and use a lower number. It's completely arbitrary, but you say, look, I'm going to use 5% lower cash flows. It's not my preferred choice, but I see some analysts doing it. Second, you can try to adjust the discount rate for complexity. Use a higher cost of capital for complex companies. And remember, I spent a month on this topic, so I could try out. One of the things I did during the month was I took the S&P 500, I split it right down the middle into 250 simple companies and 250 complex companies. Basically, I had to make some subjective judgments. And remember how we computed the implied equity risk premium? You took I computed an implied equity risk premium for the two groups. The implied cost of equity for complex companies was about 1% higher than the implied cost of equity for simple companies. How would I play that out? You give me a complex company to value. I'll take risk-free rate plus beta times risk premium plus a complexity 1%. Pushes up the discount rate, lowers value. But my favorite device for dealing with complexity is you think back to growth. What is it that drives the value of growth? What you earn as a return on capital relative to your cost of capital, right? So when you have a company that's earning well above its cost of capital, and you assume you can keep doing it, you must understand the reason they have a return on capital that exceeds the cost of capital. If I'm valuing Amgen, and the return on capital is 10% higher than the cost of capital, you ask me why, what's my answer going to be? What is it about pharmaceutical companies that allows them to earn more than their cost of capital? And keep the competition out? Because when you earn more than your cost of capital, everybody wants to get in, right? So why isn't everybody kind of getting into the weight loss drug business and driving Novo Nordisk's return on capital to the cost of capital? There's patents, no? Eli Lilly is the first breach in the wall because they've spent the money, but it took them 3 years to get that. There are other companies that are further back, so the patent is there, so I can say that's why. In the late 90s, one of the most highly valued companies, highly valued, not in terms of numbers, but the number of people valuing the company, was a company called Enron. Enron is now the stuff of legend, right? To a person, every person who valued Enron in the 1990s would come into my office with a question. They say, I can see this company makes a lot of money. And this was not even without the accounting scandal and stuff. What do they do? You know what? I never had a clean answer. They called themselves energy traders. What does that even mean? Who are you buying the energy from? Who are you selling it to? Why are you able to make money? And I never got a clean answer from anybody in Enron on that question because they said, we make a lot of money, trust us. And you look at their financials, completely opaque. And every person who came up with this, I said, the only thing you can do is to make the return on capital go to the cost of capital very quickly, because if you don't know how they make money, how can you assume they can keep doing whatever they're doing? Because it's too mysterious in the first place. If you truly don't understand why your company is earning above its cost of capital, then the device to capture that is to bring those two together. And when you bring them together, what happens? The value of growth effectively goes to zero. Once you did that, Enron never looked undervalued to any of those people, which would have been good in hindsight. Final piece on that. I'm getting to the end of the month. I have like 2 days left in the month. I'm ready to. So each of these is a piece you can pull off. It's somewhere. It's on my webpage. I try a final trick to see if complexity matters. I took the 100 largest market cap companies in the US. I took their price to book ratios, and later in this class we'll talk about price to book. The three variables you use to explain price to book ratios are betas, growth, and payout. I threw them in there. And then I threw in the number of pages in the 10K into that. What is that minus the 0.00? How would you read that? Intuitively, what am I telling you? The more pages you have in your 10K, the lower the price. In fact, I'm going further. Every 100 additional pages in your 10K lowers your price to book ratio by 0.3. You know what Citi's price to book ratio was when I did this? It's 0.9. I have a very simple proposal to double your price to book ratio. What do you need to do? Knock off 300 pages from your 10K. Sounds facetious, but if you simplify, you'd be worth it. I am convinced that money center banks today are being punished because people just don't understand what they do. There's too much opacity. Do you really know what JP Morgan does? You think they're a bank, they're an investment bank, they're a trader. I really don't. I mean, and how do I deal with that? When you value banks, you're not building in those returns and equity for the long term because you just. Is there a fixed? If Jamie Dimon called you tonight, let's say when you get home, there's a voicemail from Jamie Dimon saying, "Call me. I need your advice on how to restructure JP Morgan." Given that this complexity is hurting banks, what should Jamie do? You don't have to sell it off. Spin off each. You can have a JP Morgan Investment Management, a JP Morgan Bank, a JP Morgan. I think JP Morgan will be worth more as 5 separate businesses because then I can value each business. Will Jamie do it? Not in this universe. Why? Because he likes running an empire, the largest bank in the world. So, but I think money center banks, this is increasingly something to think about. So on Monday, when we start up, we're going to do the last few loose ends, but you have all the ammunition you need to do the valuation of your company. So please, if you haven't started, tomorrow you'll get a nag saying get started with the spreadsheet.
Hi, Professor. I got a question about the trust loss and trust regain for the Facebook story. So I think that's a similar like story happens to Alibaba when back in 2 years ago, like their main business like
But there's another reason the trust was lost, right? When you think
the
Alibaba,
government, right?
right?
Uh-huh.
When your founder disappears for 12 months and you don't know where he is, that's when you got to make people say, well, I don't know who's running the company. What that was that Jack Ma, the face of the company, was very much part of the story of Alibaba, disappeared, and people had no idea who was making a big decision. That was part of itself. The other is that much of what Alibaba has done since 2015 is not created. It's been growing the company, but there's a trust So I think there are a couple of reasons the trust was lost. I mean, I'm not sure it's fully regained yet. I mean, Alibaba still looks undervalued. You take the numbers and say, why is it trading at this number? You could argue that based on the numbers, it's trading. There's another factor among the trust, which is the government is now very much part of the trust. And the big issue there is the government Alibaba's ally, which is what the old story was, or is it adversary, which is the post 2009? That's what keeps the value, I think, below, and that's what, Charlie Munger looking back said, the biggest mistake we made was buying Alibaba thinking it was cheap, and it kept getting cheaper. Because that trust component, I think, is eroding.
And also, like, back to why, like, Charlie Munger, like, thought that was a mistake. It's like, I think he used to think Alibaba as a tech company, but, like, it turned out to be a retail company. But, like,
Not even that, right? It's an advertising.
yes,
It's
advertising.
really not even a retail company. Basically, how does it make money? You go to, Taobao.
Taobao,
Tmall. What
Tmall.
you see is basically retailers. Every time, it's more like a payment processing company. You buy from any
Commission
retailer,
fee and everything.
Alibaba gets this, which is a great business model because it's very lightly capital intensive. But it's also a business model where your marketing costs tiny, it's 0.01%, 0.03%. You're dependent on gross transaction values constantly going